Ladies and gentlemen, welcome again. Knowledge, patience, conviction, and discipline are important traits to be successful in all areas of our lives. Investing is no different. Talking of these traits rhetorically and applying these practically are two very different things. But for the better investing experience, these act as a pillar for making informed decisions. So, ladies and gentlemen, let us try to understand how do rich investors actually make wise investments? And the eminent panelists for this discussion are Mr. Ananya Kumar, Mr. Nimesh Mehta, Mr. Shankar Gopalan. And ladies and gentlemen, this panel is going to be moderated by a very eminent moderator, Ms. Kanika Agarwal. Let me take a moment and introduce my eminent panelists to you, ladies and gentlemen. Mr. Ananya Kumar is the Senior Executive Vice President and National Sales Head at IIFL Wealth and Asset Management. In this role, his focus is to build a profitable retail franchise and ensure that IIFL AMC becomes the foremost choice for investors and distributors across asset categories. Now, during his professional journey of more than 2 decades, he has held several senior leadership positions with banks and asset management companies and has managed relationships across B2B and B2C verticals. And prior to joining IIFL Wealth, he was associated with Invesco Mutual Fund as director and head of sales. A very warm welcome to you, Mr. Ananya Kumar.
Thank you.
Ladies and gentlemen, welcome, sir. Ladies and gentlemen, next let me introduce to you our next speaker, Mr. Nimesh Mehta, who heads the business development for equity PMS and real estate funds in domestic markets at ASK Investment Managers and is also responsible for offshore sales through the distribution network. He is a commerce graduate, an MBA, and certified financial planner who has over 20 years of experience in industries ranging from NBFC, equities, asset management, and financial services. Now, he has worked with Motilal Oswal AMC, GE Money, and Godrej Appliances, and has authored the international bestseller book on Amazon titled Sales Booster. Warm welcome to you, Mr. Nimesh Mehta. Next, ladies and gentlemen, we have with us Mr. Shankar Gopalan, who heads the sales and distribution initiatives at Quest. He has over 16 years of experience in channel sales and distribution management. He has worked across both mass distribution and niche products, spanning the spectrum of mutual funds, PMS and AIFs. And he has a keen pulse of both key stakeholders, distributors and investors. Prior to Quest, he was associated with Sundaram Asset Management Company Limited and Sundaram Alternates Assets Limited for over a decade and a half. And he has completed his BCom from St. Joseph's College, Tiruchirappalli, and MBA from ICFAI, Mumbai. Warm welcome to you, Mr. Gopalan.
Thank you.
And ladies and gentlemen, this session will be moderated by Ms. Kanika Agarwal, who is the co-founder of Upside AI and has a total of 14 years of work experience in financial services. She spent approximately 4 years with Mayfield Funds India, practice advising Mayfield India Fund about investments in consumer, internet, apparel, retail, food, technology, and enterprise businesses. And before Mayfield, she worked with Credit Suisse in their investment banking team advising technology. She's a chartered accountant with an All India rank of 18 and a chartered financial analyst CFA degree holder. Warm welcome to you, Ms. Agarwal. So happy to have you with us. And now the proceedings are over to you.
Thank you, Aishwarya. Hi, Shankar, Ananya, Nimesh. Very excited to talk to you guys and share these secrets with the rest of the audience that we have here. We'll just dive right in, to the questions that we have. Maybe opening comments are a good place to start. So why do you think rich investors make wiser investments? Shankar, maybe you can kick us off.
Thank you, Kanika. I feel elated to be part of this panel. To my mind, a successful investor need not be smart during the investment journey. One has to be really methodological and at the same time control the behavior when it approaches the investment products or investment avenues at the end of the time, right? Being very, very structural is very important for an investor to make the journey very smooth. At the same time, not shifting the goalpost, and also understand the fact that choosing a right investment product is not about earning the higher returns. It is most importantly about getting the decent return, which is replicable over longer period of time. And I feel the investor segment which we are talking about today has cracked this code very well.
Got it. Got it. Great. No, very, very interesting. And I'd love to dive deeper, but would love to hear from Ananya first. What do you think?
Well, hi. Good evening, everyone. And, I would rather put it in a little different way. I would rather say that for one to be a wiser investment, there are certain critical elements which are required. And the most important one is the knowledge, that you should have an understanding and knowledge of what you are doing. And for that, access to information are very, very critical. So you will see this segment that we are talking about, they have an access to a lot of knowledge sources through various means, and that obviously makes them a little bit more wiser. Second most very important thing is the approach that you take when you do the investments, whether you are impulsive or you are thinking through it well. And which is again a function of the risk-taking capabilities and all of that. So I would say they are the ones you will find them not to be very impulsive in their approach. And that's another which is very critical one. Goes without saying whether you are rich or not rich, but there are enough evidences which says that more than the selection, what is really important is in asset allocation. So asset allocation is the third important one, which where they really are pretty disciplined about it because that's the way they really take these services of the advisors and all. And the fourth one, the last one but not the least, is the time on their hands. So they have that bit of perspective in terms of letting the investment grow at its own pace and not be in a hurry in terms of looking for the rewards. So I would rather call it the four ingredients which are very critical to the investment and the wealth creations. We do see it being very common among the ultra HNIs.
Right, got it. And all of that stems from knowledge, right? If you have, you read enough, you spend enough time, you're able to do each of those things. Interesting. Sure. Got it. Nimesh, what about you? Shankar and Ananya make some interesting points. What else do you think helps them make wiser investments?
Yeah, thank you, Kanika. So let us first understand how these investors became rich. Before they, make a wise decisions, they became rich and wealthy because they invested in their own businesses or some other businesses. To start their own businesses, they followed their conviction, their passion. And when you run a business over a longer period of time, you understand the risks, you understand the entrepreneurial spirit, you understand the opportunities, you understand, the challenges. And over a longer period of time, you develop that most important patience. All of us will agree that experience is the best teacher. And therefore, when the investors go through the ups and downs of the business cycle, they develop that knowledge. They develop that good rituals. They are ready to learn. They're ready to be open in life. And therefore, I must say that this experience, explore different cycles, the knowledge, the habits, the rituals they develop, and the open-mindedness makes rich investors make wiser investments in life.
Right. Got it. So that's why you're sort of separating out, right? Wealth creation needs smaller, concentrated bets, which teach you enough thokre khalo, right? And then you move on to actually what do you do with that money and that knowledge. Yeah, very, very interesting. Maybe we can dive a little bit deeper, Shankar, specifically into, you made some of these comments right at the beginning, but everyone's saying return, etc. You mentioned asset allocation. Do you think that as they evolve, their understanding of risk becomes more nuanced, and that is a great differentiator between people who do or investors who do very well versus investors who don't. The guys who do well actually understand that risk return curve and where they want to fall on it.
Certainly, yes. Risk and risk mitigation might sound very technical to one's mind, but to my mind, this can be very well answered by time. Time in the sense of both before choosing your product, analyzing, getting into nitty-gritties of the product, and at the same time spending enough time after investing in a particular product will dilute a lot of risk, potential risk rather, which an investor would face in a normal circumstances at the end of the day. And the second important thing is being methodical, and following the process will also help them to kind of dilute a lot of risk. Being methodical, right, starts from defining the objective of the portfolio and defining the expectation from each of those investments which they choose to be part of the portfolio, right? And this segment particularly spends a lot of time in understanding the manager and the house really well. They would probably want to know the philosophy, the style, so that they can probably picture it and position it in the right place within the portfolio as such. Uh, and needless to say, you should have right amount of capital, which ensures enough diversification within your portfolio, which doesn't kind of overtly, skew your portfolio towards one particular style or one particular asset class, and doing periodical review and rebalancing the portfolio. But most important thing, as a successful investor, as a wiser investor, you need not react to all the news and events which flows, which doesn't challenge the overall thesis with which you have designed the portfolio. You actually designed the portfolio for a longer period of time. These news are kind of impacting the shorter end, but you need not really worry about and act accordingly. So to my mind, one who understands this really well can kind of scale through all the risk in a easy fashion. Either they do it by themselves, or they have a set of seasoned professionals who could probably do it on a very frequent basis. So that, according to me, is the mantra behind.
Right, got it. And I think we're going to talk about the book enough, considering that's the theme of this event, right? Richer, wiser, happier. A lot of the investors within that talk about the best way to make money, especially in equity markets, is sort of not or be able to mitigate your losses or not make any disastrous mistakes. You don't need to do anything great, but don't do anything extremely stupid, in the words of Munger, right? And that's a great way of sort of looking at it, which is, how stupid are you? I think that's how Munger uses that word a lot throughout his interview in the book. So Ananya, how much of their investment behavior, rich investors or successful investors, is wealth creation versus wealth preservation? And do you think that there should be a healthy tension between these two constantly? And does that constantly change in terms of where you are at your stage in life or what you're trying to achieve with your goals?
So Kanika, I think partly you did answer the question as well. I think wealth creation and preservation, that everybody would want to see the wealth grow. But what is very, very critical in your aspiration is also at what stage of life you are in. So I think that's very critical, because however rich you may be, there would be a certain point of time when you would move into a preservation mode rather than looking at a creation. But let's assume that we are talking about a stage bracket, which is more in terms of accumulation and all of those people. So then, wealth creation is again a function, and my friend Nimesh touched upon that topic, which is a little bit of an approach that this segment looks into it, which is you don't actually behave like an investor. You start thinking like an entrepreneur. So when you think like an entrepreneur, which is the right way of wealth creation to happen, is you start getting deep into the companies, you start getting deep into the ideas, into the philosophy. You really want to see where your monies are getting parked. You really want to see what kind of risk assessment that you are doing, what are the downsides, what are drawdowns. So you have started thinking like a true entrepreneur, the way an entrepreneur starts behaving. And then you would want to live with a gestation period, because you really would want those J curves to mature in a nice way. And that is actually leading to the wealth creation happening. So yes, I think the beauty about the segment that we are talking about is the approach that they look at whenever they look at any of the investment ideas, and this approach is in a very simplistic manner, if one can put it, is like an entrepreneurial approach, which is they really would want to think as if they're investing in their own company. How would they be evaluating them? And that's where the wealth creation as a proposition starts becoming far and more compelling for them. But yes, come what may, there will be a certain stage of life where you would really want to contain your greed, and then we start looking at, am I able to preserve my capital or not? Probably the propensity on preservation to the wealth creation quite possibly differ as we move up the ladder on the segmentation. Maybe down the ladder, the propensity to see this preservation urge being higher may not be as much as we go up the ladder, because you still have that quantum of risk taking capabilities, so see certain erosion. But I think it's both the philosophies do stay. Initial phases is more of a creation where behavioral aspects are very different, and as they progress, it starts getting into on a preservation mode.
Right, and accordingly, to the point on Shankar, your asset allocations start changing. And I guess the point that we're hearing so far is that people who are successful investors are actually able to understand, when they need to make these switches. They understand the kind of risk they're taking. They need to understand the kind of products they're buying and the approaches why they're buying a certain product. Is something that you need to look at on a holistic basis throughout your portfolio. Right. No, very interesting. And I think there's a lot of learnings for retail guys. It doesn't matter if it's, 1 lakh or 1 crore, right? Principles still apply. And I guess, Nimesh, over to you. A lot of the demographic of people who have made money are obviously slightly older, typically in their 40s, have some years of investing behind them. Do you think this becomes a time in the market and not timing the market? Wealth and wisdom compound over time, right? What do you think is? Do you think time plays a massive role in terms of how they end up doing well?
Yeah, so you use the word wealth and wisdom compound over time, and my answer would be yes and no both. Tell you why.
Right.
No, because wisdom is not an automatic outcome. Okay. I know so many people and so many, I would say traders, investors trading and investing for the last 30 years, but they haven't been able to build their wealth because they kept doing the same thing again and again, and they're expecting different results. So I yesterday addressed a Rotary Club people, and they were in the mid 50s, mid 60s, not created wealth. Knowledge metamorphoses into wisdom only if you reflect on your investing experience. You learn from books like Richer, Happier kind of investors, and so when you reflect, when you learn, is when you develop and it converts into a wisdom. Similarly, in the case of wealth, you can't get rich by compounding your money in JP Associates and Unitex of the world or Lanco Infra of the world. So by default, it cannot. So that was a no part of the answer, that wealth and wisdom doesn't compound. And I'll say yes, time in the market and compounding makes a world of difference. Again, when I was talking to this Rotary Club people yesterday, and I gave them, my favorite slide that, Sensex returns since inception. So if you had started 1 crore of investing in 1979, 42 years back, what would the value be? And when I told them that your money would have grown to 580, 590 crores, and all of their eyes popped up saying, what? And because they have seen this at 60s age, they have seen this 42 years in front of them. And the compounding was just about 15.9%. I mean, not just about a decent compounding of 15.9%. And therefore, many times customers ask me that what's the next multi-bagger? I just say that, buy into and stay equities for a long period of time, maybe 2-3 decades, which I heard was probably the finest. And as I'm speaking to you, let me give a second thing. I get reminded of the Warren Buffett's net worth and compounding. So Warren Buffett had last year about $85 billion of net worth. Okay. Let's do an experiment just to make it simpler for everyone. Just say Buffett started investing with $25,000 at age 30. Typically, all of us start investing at about age 30. And, around 60, we say, okay, abhi time khatam ho gaya. Let's enjoy, play cricket, enjoy with grandchildren, etc. So Buffett did the same, let's assume. Buffett had compounded his wealth all the time of 22%. So he started $25,000, let's say, and at 30 to 60, he compounded 22% for all the time. Just suppose he stops his investing at age 60, what would have been his value? It is just about $12 million and not $85 billion, which is 99.9% less than what his net worth has been there. So all of us know that Buffett is a great investor, or Buffett, his skills are investing. But the real success for Buffett's wealth creation is the time. He has compounded his wealth. He's held on to stocks longer than the average investor, and that's the most important part. Now, this story of Buffett will not be well understood if you don't combine. All of us know that Buffett is the richest investor, but I don't know how many people know the investor is Jim Simons of Renaissance Holdings, he has compounded wealth at 66%, 3 times the what Buffett has done. Okay, but when the measurement happened for his net worth was $21 billion, and Buffett's is what 25% of what Buffett, and compounding 3 times what he did. This irrational kind of difference is there because Jim Simons started to get 66% of returns after the age of 50 years. So he didn't have the compounding time which Buffett had, and he could not do. And just to end, since we are in the world of PMS, and this is a US story, at ASK we have the oldest PMS in the country, which was started in 29 Jan 2001. So just about 11 Feb. So we are about 11 days back, 12 days back, we complete 21 years of investing. So an investor who would have put money about 21 years back in Nifty would have grown his wealth 1 crore to become 13 crores. I'm rounding off the number at 13% compounded. At 20% compounded with ASK, his 1 crore would have become 48 crores. And that's the power of compounding. So it is important to be time in the market, but what do you select, and what the quality of stocks, the quality portfolio becomes extremely, extremely important. So I would end it.
Got it. No, I think the no part of your response was interesting, right? A lot of investors are unable to be objective about whether they're making mistakes or not. I think Nikhil Kamath recently put out a post on Zerodha, right, about how most traders on their platform lose money. Right? I don't even think they know that net of fees, etc., they're losing money. And I don't think, and I wonder, do you guys think, just throwing this out there, anyone can take this. Do you think that the rich guys with the khujri to do trading are actually understanding that we're also not making money, our money is being compounded by these experts who we gave money to and forgot about, and they're just doing a little bit of fun play here? How do you break up that behavior?
Say again, how do you
break up that behavior?
So one comes by on his self, and I was saying this again, going back to the Rotary Club investors again and again, that one needs to be very disciplined about it. Okay, one can do it, but there is this phobia of investors in the country who are wanted to do things on their own and doesn't want to give the professional. But in every area of life, they're happy to give it to a profession. So, for example, in the medical field, they say go to a doctor. In the law field, they say go to a lawyer, and every other field. But when it comes to their own stock investing, they want to dabble themselves. And I was telling everybody that because you cannot control your greed and fear. Okay, the greed, when the market goes up, you continue to increase your positions, or keep increasing your allocation to equity. And in the fear, things go down, the markets are down, you get really fearful. So unless you understand that, and the best thing, so there's a good Parsi investor, and he told very clearly that in Gujarati, he said, I will leave it to the best guys. I will identify the best professionals and leave the money with them. So the time they understand that this is a professional job, it is not that I can do part-time where I can just, do my business or start some television or read some newspaper magazines and, try to dabble into investing. And, once that awakening, once that awareness happens, that's where the role of the AMCs, role of advisors come into play to keep educating them. That you leave it to the professional. I think you'll be better off than trying to do. And when you share your own examples, in my case also in early part of career, we all have lost money. It's not that we have made money, but we've learned from our mistakes. When you share that honest mistakes with the investors, they reflected upon it and they said, I also done the same mistake. And then when I told them, why don't you hand over? Spend time in selecting a manager, selecting an advisor, rather than trying to do it yourself. You don't take the injection yourself, right? Because you don't want to pay money to the doctor. So that's the role of the advisor, role of ours, to keep guiding them, keep aware, making them aware, and share your own examples. I think that makes them break that pattern, I would say.
Kanika, if I just add to what Nimesh was saying, the most critical part, if you're really looking for a serious wealth creation, is to learn the discipline to selling greed and buying fear. Unfortunately, the behavior just goes opposite. And that's where when Mr. Kamath makes a statement, it doesn't surprises us.
Yeah.
Now, to buy, fear and sell greed cannot come on its own, because we are all driven by impulsive nature, and that to contain that impulsiveness needs a guidance of people who are independently giving an advice to say this is the way to be done.
Right. Right.
Agree.
I think recently mutual funds, there was some mutual fund manager who said that usually mutual fund investor returns are constantly lagging actual mutual fund CAGRs, right? And a lot of that is exactly what we're saying, which is people are exiting at the wrong time and buying at the wrong time, etc. And it's not just that, right? Of course, there is experts, but now there is a whole host of products that we have available. Lots of rules-based investing, lots of ETFs, products like us or Quest, or everyone is. Very different approaches are coming into play today for investors. So Shankar, do you think you've had experience on the AMC side and on the PMS side? How open are these involved investors to try new different things? Do you think that sort of helps them make wiser decisions? Their ability to be more open-minded about completely different types of asset classes or approaches?
Yeah. As per my experience, let's divide this into two, right? One is a newer asset class, which is kind of evolving at a period of time, and also a newer products which are coming within the same asset class where the investor already has some exposure. The first part, they do have a very open mind in terms of getting into the nitty-gritties of the product, understanding what are the pluses and minuses of the product, and actually these kind of investors do well not just because investing in that particular asset class because it's just something new, like crypto or NFT, right? But it should fit into the overall objective of the portfolio, and it should add meaningful alpha to the portfolio. So that aside, if you probably go to an investor who is already invested in a similar product and take a new product to him or her, the first question which they would probably answer is the want of it rather than the need of it, right? They should be with a similar long only approach. You can have very many combinations within the portfolio. Probably one might look at value, one might look at value and growth, and there are certain methodology behind this madness at the end of the day. So they would probably understand that if they feel it complements the overall portfolio at the end of the day, then they do take that plunge, they do take that this thing. But at the end of the day, if X is the amount which they want to commit to that particular manager, they would probably start with X by 4 or X by 2 and then gradually improve it as they gain confidence over it. So yes, they're open to newer ideas, but they stick to what a rigid process which they would have set or their advisor would have set and fit in the overall objective of the product with their portfolio as such.
Right. Got it. And I'd love to go around the table and really understand where are rich investors parking their money today. I know it's very cliche, rich investors, but really, what's going on? Where are people allocating? It's a pretty, choppy market. Today was pretty red. Great day to be actually having this conversation. How are they allocating? Which asset classes, etc., are seeing a lot of interest? Would love to hear from all three of you. Maybe Nimesh, you could kick us off.
Yeah, sure. So in my experience on the investors, and sorry, I'm just going back to yesterday's conversation again and again. I am seeing a clear trend or a focus shifting from the physical assets to the financial assets. Very clear pattern which you can see there. Investors are no more buying in terms of real estate if they already have one home and maybe one extra home or two homes. They are in the earlier days, maybe a decade back or sometime, I used to see them having third home, fourth home, kept on investing. But they realize that there's a lot of challenge in maintenance. There's a lot of challenge with regards to illiquidity, accounting, etc. And therefore, we are seeing a lot of money moving to financial. Now, within the financial, I think you made it a point also about mutual funds. Look at the mutual fund SIP numbers, which have been very high. Look at the demat accounts which are open. So I think we're seeing a pattern very clearly towards equity. And I must say, this pandemic has taught something really, really to all these investors. And I think that's bringing a lot of change because they could not sell their real estate. They could not sell their gold. Okay. But if they were owners of mutual funds, PMSs or stocks themselves, they could liquidate and get the money in, about 4 or 5 days time. And therefore, this also is on the mind of the people. Maybe when I used to meet people about pre-pandemic time, there would be about still a large set of people who say they want to go in real estate. But I think post-pandemic is one of the first sessions I met people in public in terms of customers, and I found there was a huge shift between the mindset that people said, "Abhi yaar, thoda real estate se stay away karte," and therefore people are looking at financial. Within the financial, they're looking at equities as an asset class strongly.
Interesting. And yeah, what are you seeing, on the EMC side of things?
So I would put it a little differently. I would say that the people who have seen the wealth creation happening over the last 1 odd years, and I'm talking about the informed investors, I'm not talking about the impulsive ones.
Right.
See, if I see the trend building up, even if I look at it 2021 as a year where we have seen close to 1.3 lakh crores kind of a money getting raised through the IPOs, I'm talking 60, 65 IPOs. So one trend which is clearly getting visible is an interest in the unlisted space. I think that's where we can see a lot of buoyancy, a lot of interest. Now you can call it in any way, whether it's an NSE or an NSDL or whatever. But the reality is that there's a clear trend building up in that space, which is there. I can also see with the yields, the way the yields are looking like today, I can see the structured credit as a proposition, which is where a lot of interests are getting built up now. The investors are pretty keen on onboarding some kind of a risk, even if they are going down the ladder on the credit side, and if that can compound some kind of an yield upside to them, they are happy to look at it. I think a little bit of a deviation to what my friend Nimesh said. I also feel that there is an emergence, or there is an interest which is also visible, and I'm not talking about financial assets only, in the real estate as well. So I can see all those postponement approaches that the people were having in terms of graduating to their upsides, 3 becoming 4 or 4 converting into bungalows. Now I can see also that being clearly getting visible, and recent data which got published, I'm not sure, I think Knight Frank was the one who published it, contrary to the previous data which came in around 2 years back, with the inventory levels, if I look at in Mumbai, was at a lifetime high. Those decently got absorbed recently. So I would say it's a classic mix that one can notice. There is an interest which is visible in the glittering gold as well. People had shifted their portfolios because of emergence of a lot of taperings and all of that which is happening. So there is a shift of the interest into gold as well, which is getting visible, and the risk-taking investors continue to look at, as I said, in the unlisted space or a structured credit. So I would say not a clear shift into one particular asset class, which is pretty widespread. But yes, everyone is raising their stakes depending upon what kind of risk appetites and what is the need and assessments are. But I would say it's pretty well widespread.
So I'll just step in, Kanika, and Ananya made a good point, which I would have said that. So within real estate, what is happening is the clients are not investing directly in physical assets. They're looking at professional managers, P fund managers, AIF managers, to help them, and in that real estate management, because they realize that again this is an expert role, and they can, instead of getting into one single property and doing they're saying, why not have a basket of 10 properties, real estate property or commercial, whatever they want to do, through a professional fund management. And I think that is a very clear trend which has been visible, where people are getting inclined in the AIFs which invest into real estate.
Got it. But key there seems to be one, financialization, and two, holding on to a little bit of liquidity in terms of their assets, right? Those two seem to be very big learnings for the last couple of years. So, and Shankar, what are you seeing, at your end in terms of, no one has used the words crypto or NFT yet, just putting this out there. So Shankar, where are people parking their money? What are the trends you're seeing?
And I doubt whether we can still call cryptos as assets as said, right? There's not.
I think that's a separate conference, not this one.
So my answer to that question would be a bit from Nimesh and a bit from Ananya, right? And of course, we are operating in the same field where we see the trends very clearly moving towards one segment or the other. But our personal experience have been investors still have a very decent and a large allocation towards listed Indian equities. That's one. That has been accumulated over a period of time, and we're talking about rich investors who have kind of identified these ideas for a longer period of time and then been sticking to it and identifying newer ideas. But our experience for the incremental money from this particular segment is chasing two asset classes, and thanks to whatever volatility or the noise behind the valuation which has been there in the listed space. One is RE, both at the physical asset space and the financial asset space. People, like what Nimesh said, people don't hesitate to participate in AIFs for the want of higher yields and a better visibility in terms of the real estate space as such, and also a better visibility in terms of the physical assets. People who've been watching a particular property for years and years together and probably taking the plunge at the point in time. The second aspect is the PE space, both at the early stage and at the late stage. The valuation argument which stands against the listed space, unfortunately or fortunately, plays for the PE space as such. So there is a lot of interest which is kind of getting in. So our experience has been this.
Got it. Got it. And of course, there's diversification internationally, at the AMC level. I know RBI has some other norms, but are you guys seeing that as, different conversations people are having, which is, should I be doing this Taiwan fund or this, US, NASDAQ, etc. Is that coming more to the fore now?
No, it does, Kanika. In fact, one can see the kind of interest that an ARK fund got built in. So we all know what NASDAQ did for the investors last year.
Yeah.
So goes without saying, diversification has always been the key to success. And when we talk about diversification, one of the aspects also is to look beyond the boundaries. And there has been enough interest. In fact, I'm absolutely in confirmation with you that yes, international fund is also one option which people had been exploring, and unfortunately, the only risk that you have and that's where the interests are limited. One is that to LRS mode, how much early can you do it? Which obviously contains until you take a feeder route. Either you take a feeder route and it's a different story. Otherwise, you have those cross currencies and all of that. But I must tell you one thing, which is very noticeable, is the phenomenon which is getting noticed now is an approach to build the international assets, not for anything else, but for the fulfillment of their own needs in future. For example, if they would want their kids to go out and abroad and study, so they already have started accumulating those international assets, the dollar assets and all, which can be consumed at a later date. So this is one phenomenon also that you can see clearly getting visible. Rather than looking at a feeder route, they are very happy to take an LRS route and then look and start building those dollar assets. So that's one other way that's an approach which is clearly visible.
Interesting. Got it. Yeah. So for us, personally, anytime we're having conversations with investors, one, because we're a tech shop, we keep getting asked, "Acha, should I buy crypto? How much crypto should I buy?" And other than that, fully agree on this US stuff. We ended up launching a US fund for exactly what the reason that you're saying. I think that there's a lot of interest to move money abroad as well. I guess last one, just want to come back and pay, homage to the book, The Richer, Wiser, Happier, which this is all based on. Any key learnings or any specific investor that you guys were particularly inspired by, or any book that you could recommend to everyone in our audience today, so they have something to go back and, some recommended reading, if you will. Shankar, Ananya, Nimesh, please.
My personal vote always goes to a manager who would probably have a fine balance between a mispriced opportunity with a limited downside, and also at the same time look at growth opportunities with a ever expanding market size. Right, someone who could probably provide me that, I would be really happy to kind of bet my money with that particular manager. I know it's pretty tough to do that, but that's what we practice, and that's what we preach as well from our end.
Right. Ananya, any takeaways from the book or any books that you think our audience should definitely be reading?
So I would say, I think let's stick to the basics. I think the book written by Mr. Benjamin Graham and says The Intelligent Investor is a beautiful book. It's just it just sums it up in a very I would say in a simplistic manner. He has explained this nuances of investments. I would say let's keep it simple. Let's just read the basics and stick to this. Believe you me, wealth creation, if we keep it simple, is very easy to be done. We only are the one who complicate it by just getting too many things into it. So that's where I would say.
Right. Nimesh, of course, the first book you would recommend is your book. What's the second one?
It's not on finance, so I cannot. But yes, some of the principles can be followed. But I would say, for me personally, the finance books or my relationship with money initially changed by reading Robert Kiyosaki books, The Rich Dad Poor Dad, all series of books, Cash Flow Quadrant and all. And those gave me very good insights of building assets versus liabilities. And I think that changed a lot. And then, very recently, last year, 2 years back, or maybe last year only, I read the book from Psychology of Money by Morgan Housel. I think that's been a wonderful book. I don't think, and why would I, rate that book very high? Once you get through this book, The Psychology of Money, I don't think you need to read many books on I tell my team also, because it teaches you the art part. I think behavioral finance is very, very important for anyone to create wealth. And that book beautifully puts forward how your relationship with money changes, how one should, think about wealth, which I would say each one of audiences should really do, because it teaches the art part in behavioral finance. And that would be my recommendation, Robert Kiyosaki and Morgan Housel as the two authors.
Okay. No, wonderful. Thank you so much, Shankar and Ananya and Nimesh. It was wonderful talking to you guys. I hope the audience had a good